Hello and welcome to Collin Investing, your go-to channel for principal analysis on finance and investment. I am Collin, and I am thrilled to have you join us. We are going to unravel complex market events, evaluate emerging trends, and present clear investment strategies. Today we'll be diving into a range of topics that are shaping the financial landscape, starting with major global shifts, then examining critical market risks, and finally, we will explore some compelling individual stock opportunities and portfolio diversification options. Let's begin. Building on our introductory points about the complex interplay of global finance, let's turn our attention to a situation unfolding with significant societal and economic ramifications. The Ukraine conflict. The landscape here is shifting rapidly, and it's crucial to understand the underlying currents. We're seeing reports of US-Russia talks, hinting at a potential deal. The details are still emerging, but the implications for Ukrainian territory and sovereignty are profound. Consider a situation where major powers are negotiating the fate of a nation, and that nation isn't even at the table. This is not new, but the implications must be understood. And that's where the US stance towards President Zelensky comes into a sharp focus. We've observed a marked shift from outright criticism to what appears to be a move towards conditional support. What's driving this change? Power dynamics. This is largely tied to a new mineral deal, a simplified, perhaps less overtly controversial, version of a previous agreement that sparked significant backlash. Now, you might be wondering about the broader European perspective. There are growing concerns, with some analysts even drawing parallels to the 1938 Munich Agreement, a historical event with a heavy legacy. The future of NATO itself is being openly questioned. A remarkable development, however, here is a counterpoint to consider. Zelensky is facing mounting challenges, declining public support, persistent questions about his legitimacy, and a series of military setbacks that are hard to ignore. Imagine that you are in his place. The pressure must be immense. With that in mind, let's examine Turkey's increasingly assertive role. President Erdogan's intervention amidst these US-Russia negotiations is a clear signal of Turkey's regional ambitions. It is an important player now, and that leads us to Ukraine's attack on a Russian oil facility. This wasn't a random act, it's a message. I interpret this as a calculated signal of defiance, a demonstration of Ukraine's changing tactics in this increasingly complex conflict. The impact, interestingly, extends beyond just Russia, given US interest in that very facility. This brings us to a critical question. What about Trump's evolving strategy with Zelensky? The former president's approach to Zelensky has been, shall we say, volatile. Understanding this dynamic is key to forecasting the potential trajectory of this conflict and its ultimate impact on the global investment landscape. Remember that key concept from the previous slide about shifting dueling power and economic uncertainty? Well, it plays directly into a significant and potentially imminent risk here in the US markets. The looming US debt crisis. Ray Dalio, founder of Bridgewater Associates, one of the world's largest hedge funds, is sounding the alarm, and his warnings should be taken seriously. Dalio projects a debt crisis within the next 1 to 3 years. This isn't some distant theoretical problem, it's potentially right around the corner. The core issue is a classic supply-demand imbalance. The US government is accumulating debt at an astonishing rate, and the interest payments on that debt are becoming increasingly burdensome. Interest payments are more than $1 trillion. Simultaneously, we're seeing declining global demand for US treasuries. Other countries just don't want them like before now. You might be wondering, why is demand declining? Several factors are at play, including global tensions and concerns about the long-term sustainability of US fiscal policy. We can see it like this. If the US government cannot pay the debt by borrowing, it has to print money. It is simple as that. So, what does this all mean for investors? It means we could be facing what Dalio calls a death spiral. If the government can't find enough buyers for its debt, the Federal Reserve might be forced to step in and essentially print money to buy that debt. This is not sustainable. This devalues the currency, fuels inflation, and further erodes confidence in US treasuries, leading to even more selling. It's a vicious cycle. Dalio uses a powerful analogy. He says high levels of debt are like blood clots in the financial system. They might not cause immediate problems, but they significantly increase the risk of a major heart attack, a full-blown economic crisis. I must say this is brilliant. I agree with him, but that's not the whole story. The official US debt figures, while alarming, don't even tell the complete picture. When you factor in future welfare obligations, the actual debt burden is far, far larger. Another expert in the field brings up another relatable metaphor. It's like focusing on small waves at the beach while ignoring a massive tsunami approaching from offshore. People worry about minor, short-term issues, like the debt ceiling debates, while the underlying systemic problem, the unsustainable growth of U.S. debt, continues largely unaddressed. Building on that point about the potential for a U.S. debt crisis, let's dive deeper into the specific investment implications and strategies we should be considering. Dalio isn't just sounding the alarm. He's offering a concrete, albeit challenging solution, what he calls the 3% solution. This means drastically reducing the U.S. budget deficit to no more than 3% of GDP. Now, that requires serious fiscal discipline, something that's been in short supply lately. This brings us to a critical question. Have we seen this before? Absolutely. History is replete with examples of empires that crumbled under the weight of unsustainable debt. It happened to the Romans, the British, and many others. The common thread: excessive spending, often fueled by military expansion or unsustainable social programs, ultimately led to economic collapse, and often major global shifts. I find this very concerning. It has happened and it can happen again. So, what does this all mean for today's markets? Interestingly, Dalio and other prominent investors like Howard Marks are drawing parallels between the current market environment and the period leading up to the dot-com bubble burst in 1998-99. We're seeing high prices across many asset classes, coupled with significant interest rate risk. Think about it, those will be bad. Now, you might be wondering about the role of artificial intelligence in all of this. AI is undoubtedly a jock technology, much like the internet was in the late 90s. But, and this is a crucial but, here is a difference between recognizing the potential of a new technology and assuming that every company involved will be a guaranteed winner. Excitement often outpaces actual sustainable profitability, leading to inflated valuations and eventually painful corrections. And that's where market concentration comes in. We're currently seeing a situation where a handful of mega-cap stocks, primarily in the tech sector, dominate major market indices. This isn't unprecedented. We saw similar patterns during past bubble peaks, like the Nifty 50 era in the 1970s, and, of course, the dot-com bubble. A very select group of companies are holding things up with that in mind. Let's examine the potential risks associated with passive investing. Michael Burry, famous for predicting the 2008 financial crisis, has warned about the potential for index fund bubbles. His argument is that the massive inflows into passive index funds can distort market valuations, pushing prices for the underlying stocks to unsustainable levels, regardless of their actual fundamentals. Index funds are just not as safe as people might believe. Let's continue with strategies. We were discussing high-level strategies and potential systemic risks. Now, I want to pivot to two specific areas that are increasingly important in today's investment landscape: the escalating competition in artificial intelligence and the renewed interest in gold as a safe haven asset. First, let's talk about AI. This isn't just about tech companies battling for market share. It's much bigger. This is a national-level competition, primarily between the US and China, with profound cultural and economic implications. I see it as similar to the space race. The stakes are incredibly high, impacting not only economic dominance, but also military and technological supremacy. I believe the winner will get significant advantages. Now you might be thinking, okay, but what about gold? Gold, often perceived as a relic of the past, is experiencing a resurgence in relevance. Central banks around the world are increasing their gold reserves, and here is a noticeable shift away from traditional government bonds, particularly U.S. Treasuries. Consider the advantage. They want safety, and that's where gold's unique advantages come in. It's highly liquid, meaning it can be easily bought and sold on global markets. It offers a degree of privacy that other assets, particularly digital assets, don't. And, crucially, it's relatively free from direct government control. Central banks and governments can't simply print more gold, unlike fiat currencies. With that in mind, let's examine China's AI strategy. It's a two-pronged approach, developing relatively inexpensive but still capable AI chips and focusing on widespread practical applications, particularly in robotics. I think that is a smart move. This could give them a significant edge in certain areas, even if they're not leading in the most cutting-edge, high-performance computing aspects of AI. This leads us to an interesting paradox. How are major institutional investors positioning themselves in this environment? Let's take a look at Bridgewater Associates, Ray Dalio's firm. Their portfolio reveals a significant allocation to the S&P 500 through the SPY ETF, indicating a continued belief in the broader U.S. market. However, they've also made notable adjustments to their tech stock holdings, suggesting a degree of caution and a potential rebalancing towards sectors less exposed to the risks we've discussed. Let's shift the gears from broad market strategies to a specific, and in my view, compelling stock opportunity. Dargode. This isn't just another semiconductor company. Dargode is demonstrating impressive momentum, gaining market share in crucial high-growth areas like automotive and the Internet of Things, IoT. These aren't pie-in-the-sky future markets. These are expanding now. So, what's driving this growth? It all comes down to the increasing demand for edge AI, that is, artificial intelligence processing done directly on devices, rather than relying solely on the cloud. Think about your smartphone, your car's infotainment system, or even smart home devices. They're all becoming more powerful, capable of handling complex AI tasks locally. I was talking with a colleague the other day and we agree on one thing. We are going to have more powerful devices because of this demand. Now you might be thinking, but isn't Dargode primarily a smartphone chip company? That's historically been their core business, but the narrative is changing rapidly. The smartphone market, while mature, is undergoing a subtle but significant shift. People aren't necessarily buying more phones, but they're increasingly trading up to more premium, AI-capable devices. I even did it myself a few months ago. This means higher average selling prices for Dargode and a greater demand for their advanced chips. And that's where the valuation comes in. Dargode is currently trading at a forward price-to-earnings ratio of around 14. Compare that to the S&P 500's average forward TE of about 21. To me, that spells undervalued, especially considering the growth potential. Based on my own discounted cash flow analysis, I estimate Dargode's intrinsic value to be closer to $200 per share, significantly higher than its current market price of approximately $173. I have had this stock rated as a buy for months. The company is well positioned to continue to benefit for this. We just examined Welcome Back to Collin Investing, driven by the shift towards edge AI. Now let's turn our attention to another tech giant making significant strides in applying artificial intelligence. Alphabet, Google's parent company. But in this case, we are focusing on using AI not only for internal processing, but also for revenue. Alphabet is heavily investing in AI across its entire advertising ecosystem. This includes everything from media buying and ad creation to performance measurement. They're making it better and easier. Think of a small business owner. If the campaign is effective and at the same time very easy to run, that is what they would want. It translates into higher revenue for the company. So, what's the tangible impact of these AI investments? Well, the numbers speak for themselves. Alphabet reports that AI-powered video campaigns on YouTube are delivering a remarkable 17% higher return on ad spend, on average, compared to traditional, manually managed campaigns. That's a significant improvement, a compelling reason for advertisers to embrace AI-driven solutions. You will be losing money if you are not using AI to run your campaign. This leads to a key point. Alphabet can offer much more with much less, given its AI investments, which aren't labor-intensive. It is easy to see how this can significantly increase revenue, however. Here is a counterpoint to consider, at least from the YouTuber creator perspective. The platform's growing popularity as a viewing platform on large-screen TVs is prompting a shift in content creation strategies. More and more viewers are watching YouTube on their living room TVs, not just on their phones or tablets. This means creators, myself included, are adapting their content to cater to this larger screen experience. It's a dynamic shift, and it proves YouTube is expanding reach. With that in mind, let's examine YouTube's overall value proposition. I genuinely believe, and I know I am slightly biased as a YouTuber, that YouTube offers an unparalleled combination of content, breadth, accessibility, and value. Compared to other streaming services, it's a compelling offering, and the data suggests it's continuing to gain market share. The company just needs to keep improving the platform. Its creators will do the rest. We can all grow together. The positive growth cycle is easy to see here. So, we've explored individual stock opportunities and the importance of adapting to a changing market. Now, let's put it all together and talk about building a diversified portfolio using ETFs as exchange-traded funds. Think of ETFs as baskets of stocks, offering instant diversification and a convenient way to invest in specific sectors or strategies. I'll present a framework, my perfect for ETF approach. Now keep in mind, perfect is subjective. It depends on your individual circumstances, risk tolerance, and investment goals. However, these four provide a solid foundation forged for our core U.S. market exposure. We have the Vanguard S&P 500 ETF, VOO. This is your bedrock, giving you broad exposure to the 500 largest U.S. companies. It is simple. If you want to invest in the U.S. market, this is a very good option to consider. It is one of the largest positions in my portfolio. Second, to add dividend income and a value tilt, we consider the Schwab U.S. Dividend Equity ETF, SCHD. This ETF focuses on companies with a history of consistent dividend payments and dividend growth. I personally believe that this is the best dividend-focused ETF in the market. I like to focus on dividend growth instead of yield. The numbers speak for themselves. Since 2011 to 2022, this ETF has actually outperformed the S&P 500 third. To inject some growth potential, particularly in the technology sector, we include the Invesco Nasdaq 100 ETF, QQQM. This ETF tracks the Nasdaq -100 index, which is heavily weighted towards technology and growth stocks. We need to be careful here though. The technology sector got crushed in 2022. This is why we are not going to entirely rely on technology alone, and that is where our fourth EF comes in, the Vanguard Value EF, VTV. This one serves as a defensive counterweight, providing exposure to value-moderate companies across various sectors. It will lower the risk in a portfolio, and it has great diversification. This is not going to be a high flyer, but it is a stable compounder. I'm putting my money where my mouth is. This EF, along with VOO and SCHD, represents large positions in my portfolio. We've covered a lot of ground today, from global dual-T shifts and looming market risks to specific stock opportunities, and a framework for portfolio diversification. I hope you found this discussion insightful and valuable for your own investment journey. Now I'd love to hear from you. What are your thoughts on the topics we discussed? Do you have any questions about specific investments or strategies? And I am particularly curious, what would your perfect 4 ETF portfolio look like? Share your insights, questions, and portfolio ideas in the comments section below. Let's get a conversation going. I truly value your engagement and perspective, and of course, if you found this video helpful, please hit that like button and subscribe to Collin Investing. It helps the channel grow, and it ensures you'll stay informed about future analyses and insights. Remember, informed investing is empowered investing. Join us, and let us grow together.